Dividend growth investing is a really powerful way to compound wealth over the long term because you have multiple drivers for building your wealth. First of all, you get that passive income from the dividend check. So that reduces the need for the fund itself to grow a lot in order to generate attractive total returns because you're already getting that cash flow return. Additionally, you get the dividend growth component. And so that is a natural accelerator for the stock price. It helps to provide upward momentum for the stock price because typically with dividend stocks, the market at least partially values them based on their dividend yield because a lot of investors buy them for the income generation. And so as the yield increases from the underlying dividend per share growing, over time, the stock market will often award that investment a higher share price to accommodate that higher dividend payment to keep the yield at a similar level over time. And so that will drive the stock price appreciation. And on top of that, you also get the ability to reinvest dividends. And so you get to reinvest the dividend cash flow to buy even more shares, which in turn are growing their dividends per share on over time. So you get that compounding effect of both your growth from your number of shares increasing, which increases your passive income as well as your wealth, but also the dividends per share increasing over time. And so that's a two-tiered growth component for both your passive income and your wealth. Of course, another aspect of this that is really great is psychological in the sense that when the market gets really volatile, let's say the market goes to a 20%, even a 30% crash, if you're focused on your passive income, which is what you view as your true source of financial freedom, then it doesn't matter if the market crashes as long as those dividends keep coming in, especially if they keep growing year after year and over time at a pace that exceeds inflation, you can feel confident that, hey, my true wealth, my source of financial freedom, my ability to sustain my lifestyle is still growing over time. It's not getting destroyed by a sudden market crash. Market sentiment comes and goes, but dividends tend to last for a long time. Of course, investing in dividend ETFs takes us to a whole other level than rather just picking individual stocks. Of course, picking individual dividend stocks, which is what I do personally, has its pros. You get a higher yield. Oftentimes, if you can select your own stocks, you can get much higher total returns because you can filter out the overvalued stocks or the low quality junk stocks and just focus on that nice narrow range where you have quality and value both aligning for you along with an attractive yield. So that's why I pick my own individual stocks. But if you go with an ETF, you get a much more passive approach. You don't have to study individual stocks, read earnings calls, analyze balance sheets, or value stocks at all. And so that's one nice thing. It's really nice, especially for retirees who don't really love investing. They just know it's important. So that's one way to do it, especially if you have a low-cost ETF. It doesn't cost you a lot to take this approach. You also get instant diversification across at least dozens, many times hundreds of individual stocks. So again, that helps to reduce risks as well. Whereas if you're picking individual stocks, you're probably going to concentrate. My portfolio usually has between 20 and 30 stocks at any given time. And so I'm much more concentrated. So I have a little bit more risk there that I take on in exchange for that higher total return potential. So there are some big pros to having an ETF. Of course, not all ETFs are the same, right? Just because it's well diversified does not mean it's going to perform roughly the same as another ETF for the broader market. And so there are several aspects that you need to look at when picking an individual dividend growth ETF. And so in this video, we're going to talk about one dividend growth ETF that I think it's popular, but I think it's overrated. And another dividend ETF that it is pretty popular, but I think there's good reason for it. And I think it's actually underappreciated because of just how fundamentally great it is. But before I get into the rest of this video, if you could please give it a like, that'd really help me with its distribution, help me to grow my audience and my channel. Thank you very much. Okay, so the overrated ETF that I'm going to talk about today is the Wisdom Tree US Quality Dividend Growth ETF. It's ticker symbol DGRW. Now, it does have a lot of good things going for it, and it is very popular. In fact, it's grown its assets under management rapidly to about $14.5 billion worth. So clearly it has a lot going for it. Some of these things include a strong dividend growth track record. Over the past 10 years, it has grown its dividend at a roughly 8.5% dividend CAGR. It's delivered very strong total return performance, outperforming many of its dividend growth peers. And so that has a lot going for it. It also pays out its dividends monthly, which is quite popular with many income investors. They like that monthly cash flow that helps them to really stay in touch with their dividend income stream as opposed to the quarterly, which may require more patience in between payouts. Personally, I don't really care. It doesn't really matter. But for some investors, the psychological benefit is worth taking into account. That said, there are reasons why I think it's overrated. The biggest reason why I think it's overrated is because its expense ratio is 0.28%. And while that's not super high, it's certainly lower than some funds out there, it's quite high compared to its peers. If you look at other dividend growth ETFs, they typically have expense ratios of below 0.1%. So this one's probably on the order of like 3 times, in some cases even 4, close to 5 times as high as what many of its peers have in terms of expense ratios. And as Warren Buffett once said, performance comes, performance goes, fees last forever. And so, you may have a fund, maybe DGRW goes on a really hot run for a while, and it has, as I said, it's outperformed a lot of its peers recently. But that doesn't necessarily mean it's going to outperform moving forward. It just means it was in a period perhaps where the sectors that it targets happen to do well. And especially when it's a passive fund like DGRW is, it's really hard to put much stock in that. In fact, it's more important to look at the fees, in my view, with a passive fund for that very reason. And again, its fees are higher. So I think over the long term, as markets gyrate, it's at a natural disadvantage, let's put it that way. So that's one reason why I think it's overrated. Another reason I think it's overrated is its dividend yield is quite low. It's only about 1.5%. And that's a slightly above the S&P 500s, but it's well below a lot of its peers. And if you're investing for dividend income, you want a yield that is meaningfully higher than the S&P 500. You want to get that current yield, because if you have a low current yield, you're going to need very high dividend growth to get to a high level of dividend income over time. And so that to me is a major strike against it. And this is especially the case when coupled with the fact that yes, it has an 8.5% dividend growth CAGR over the past decade, but in the last 3 years, its dividend CAGR has only been 2.5%, and over the past year, it's only been 2%. So it's slowed considerably. Even over the past 5 years, it's only a little bit over 4%. And so when you consider the elevated inflation we've had over the past several years, that 5-year dividend CAGR probably has only roughly kept pace with inflation, and recent dividend growth has dropped down to even right in line with or even a little bit below where inflation is right now. And so not only you're getting a low yield, but it's barely keeping up with inflation. So it's not a good combination if dividend growth is important to you. And again, I would say just look at its portfolio makeup. The reason why it has outperformed peers is not some special magic formula that the management has. Again, it's a passively managed fund. It's not like they're actively managing it in some really skilled manner. No, it's just because the way it's set up for its index, it's heavily concentrated, especially more so than its peers, in mega cap tech stocks, which have crushed the market in recent years. And yeah, sure, maybe you feel like, hey, mega cap tech is going to dominate. It's going to dominate the world, overtake the world. It doesn't matter what kind of antitrust laws are out there. Anything else that happens, these companies are invincible. They're going to dominate. Okay, maybe that's your thesis, and that's fine. But then if you really believe that, why are you going to buy DGRW? Why don't you buy a NASDAQ ETF, QQQ instead, or something similar, or just buy the individual stocks themselves instead of buying a fund like DGRW? It just doesn't make any sense. So again, for its specific purpose of a dividend growth ETF, which is in the name, it's what we're talking about here, what kind of investors drawn to it. It lures you in with these glitzy returns compared to its peers, but that's only because it does a poor job of focusing on what it's supposed to do, and instead is focused on more so on mega cap tech. So again, it's like just buy QQQ and join it with one of these cheaper dividend growth ETFs if you want a hybrid like what DGRW offers. You'll pay lower fees and you'll probably get better returns overall anyway. So that's why I don't like DGRW. Now, before I get into the dividend growth ETF that I think is underrated, that I do like, if you could please subscribe to my channel, I'd greatly appreciate it. Again, it would help me to grow my audience and make these videos more worthwhile. Thank you so much. Okay, so what is the dividend ETF that I think is underrated? It's called the Vanguard Dividend Appreciation Index Fund, or ticker symbol VIG. Now, why do I think it's underrated? Well, especially compared to DGRW, its expense ratio is just 0.06%. So again, that's almost 5 times less than what DGRW's is at 0.28%. Also, its dividend yield, while still not great, it's 1.75% roughly. So it is higher than DGRW. So you're already getting a lower expense ratio and a higher current yield. That's got a lot going for it. But on top of that, VIG's dividend growth rate is also quite high. Over the past 12 months, it's exceeded 8%. So again, crushing inflation over that period by about 3 times. Then over the past 5 and 10 years, it's been over 10%. And so you're getting a very consistently high inflation crushing dividend growth rate. So yes, its yield isn't terribly high, but at least with this one, you're getting consistently high dividend growth, and its yield is already higher than DGRW. So it beats it on both fronts, as well as the expense ratio part, which again, I really like. And when it comes to its portfolio, it still has significant exposure. About a quarter of its portfolio is invested in technology stocks like Apple and other mega cap tech stocks that pay dividends. And so you're still getting plenty of mega cap tech exposure with VIG if that's important to you. But at the same time, it's not quite as overrated as DGRW is. So it has exposure to some of these other sectors as well. And because of its lower exposure to mega cap tech, it has slightly underperformed DGRW in the recent past, but still outperformed many of its other dividend growth peers. And again, it's a true dividend growth stock or dividend growth ETF. It's not something masquerading as a dividend growth ETF, but really just increasingly concentrated into mega cap tech. So again, that's why I like VIG more. And I think moving forward, again, it's going to outperform DGRW on a risk-adjusted basis. Because again, if you want to have parity in terms of mega cap tech exposure, just buy some of those mega cap tech stocks and pair it with VIG. You're going to have a much lower expense ratio. You're going to have similar dividend yield because those will probably bring down the yield a little bit, and you're going to get better dividend growth by quite a large margin based on their recent track records. So again, when it comes to dividend growth, it's a great way to invest. Dividend ETFs make it simple and passive and can help reduce risks. Sure, you trade some yield, you trade some total return and dividend growth potential taking that route. But again, there are benefits if your personal situation calls for it to go in the ETF route. But if you do ETFs, don't just chase what has performed strongly over the past 12 months in terms of price performance. Look at what your goals are. What do you need your current yield to be? What do you want your dividend growth to be? What kind of fees are you paying to the manager? And how well diversified is the portfolio so that over the long term, as sector performance comes and goes, you're going to have that steady income growth, you're going to have that steady current yield, and you're going to have that low expense ratio that minimizes frictional costs of investing. So I hope this video was helpful to you. If it was, please again, like it, subscribe to my channel. Let me know in the comments below what dividend growth ETFs you like. Thank you very much. See you next time.